Good evening, everyone. Welcome to a very special session on the Indian Union budget, which was presented earlier today. I'll be your host for this evening. My name is Raj Chakrabarti. I'm the senior partner with Kocher and Company, and I head the Mumbai team. To talk about the budget, and before I hand it over to my panelists, let me just quickly set out the context. 2025 budget was widely anticipated for multiple reasons. Everybody had their wish list: simplification of tax regime, ease of doing business, dispute resolution mechanisms to be put in place, and so on and so forth. And rightly so, because if India has a target of reaching a $5 trillion economy in next 3 to 4 years, certain structural reforms, initiatives, economic measures were certainly called for. So therefore, there was wide expectations from people, and particularly so far as the tax part is concerned, both direct as well as indirect tax. So how did the finance minister go about addressing these aspirations of Indian population? What really came through? Were there some hits? Were there some misses? And and all other attendant issues we'll be discussing this evening. So we have with us a very eminent panel today. To introduce my fellow panelists, we have Mr. Shahid Khan, our senior partner and head of direct tax. Mr. Khan is a renowned name when it comes to direct tax practices concerned. He has been a former IRS member, been part of various policy-making committees of Government of India, and someone who's widely acclaimed as an expert in all tax-related matters, including cross-border taxation issues. Joining Mr. Khan will be Reena Asthana Kher. She is a senior partner in our firm and she heads the international trade and indirect tax practice. Reena is a renowned name when it comes to indirect tax matters, all forms of international trade and taxation related issues, litigation, and advisory work. And to complement Reena, we have Shampa Bhattacharya, who is a partner in our indirect tax team. Shampa has vast experience in advising clients across sectors on indirect tax issues. She has been part of the Big Four in her previous professional life, and she joins us with a wealth of experience. So, welcome to all my fellow panelists. Before I start the formal presentation by Mr. Khan, just one housekeeping announcement. We will be taking questions from the audience, and as I can see, there are a good number of attendees already, and there will be more joining any moment. So we will be taking your questions. Please make a note of all those, and once the presentations are over, you can put your questions in the chat box and do introduce yourself if possible, and a suggestion that you should mention that to whom the question is directed, so accordingly the panelists can answer that. So without much ado, I would request Mr. Khan to talk about the direct tax implications of Union Budget 2025. Mr. Khan, over to you.
Thank you. Thank you, Raj. It's a pleasure to join this presentation this afternoon. Uh, Let me spend a couple of minutes on the context in which these tax proposals have been made by the Honourable Finance Minister. Uh, our GDP growth rate was slowing in last couple of quarters, and there was a feeling that we need to do something on private consumption and private investment. If you recall, government had announced a substantial tax relief for corporate sector in 2019 and again in 2021. But still, the private investment was not picking up, and one of the ideas floating was that we need to do something on the individual taxation, personal taxation, and this is where things have happened in the present budget proposal announced today. I think the biggest announcement that was made today was that a new income tax bill will be introduced in this very session of the Parliament, possibly in a week's time. Now, if you recall, this direct tax code has been in the making for last, I think, about 8 to 10 years, or even more. But hopefully, this time it will see the major announcement that has happened is in the context of the overall economic situation. Is that big relief has been promised in terms of individual taxation, personal taxation. And two things stand out in this regard. The announcement by the Honourable Minister said that the government has foregone a revenue tax revenue of 1 lakh crore. And how has that happened? It has increased, it has tweaked the slab rates of personal income taxation, and it has provided a mechanism by which incomes up to rupees 12 lakh will have no tax at all. So that means taxpayers whose incomes are up to 12 lakh will have zero tax. Now, this is a big change compared to what is the existing position. In the existing tax rate, incomes up to 7 lakh have been exempted by way of tax rebate. Now, please note that basic tax exemption limit was 3 lakh in the current regime, and it will move to 4 lakh in the basic exemption. There is not much change in the basic income tax exemption limit, but what has been done is that a mechanism has been devised by which the tax on income of up to 12 lakh will be reduced to nil by providing a rebate. So that's the arrangement, that's the mechanism which has been done. And a couple of new tax slabs have been introduced, and a certain tweaking of tax rates have also been made. Now, if you see the two comparable charts, the first slab will be now up to 4 lakh, there will be no tax at all. Then 5% tax bracket will apply to 4 lakh to 8 lakh, 10% for 8 lakh to 12 lakh, and so on. So in every slab, there is the tweaking of tax rate and thus the income range. Now, net result of this is that there is a tax relief for taxpayers having income up to 12 lakh, and there is also a tax relief in respect of other cases also. Chart in which the finance minister has indicated the amount of tax relief for different tax slabs. Now, this varies from 30,000 at the lowest slab to 110,000 at the highest bracket. So that means, although that means a substantial number of taxpayers in the bottom of the pyramid, that is those having incomes of 12 lakh, and they are the larger number, they will be out of tax bracket, but others also will get a certain amount of tax relief varying between 30,000 and 110,000. So that's a big announcement that there is a major tax relief, and the expectation is that this will lead to savings and therefore a boost to private consumption. And now we will have to see how it really works out, but I think the step has been taken in the right direction, and it complements the reduction in corporate tax rates a couple of years ago. There was an argument going on that whether reduction in tax rates, individual tax rates, should have preceded the reduction in corporate or vice versa. But that, I mean, this is something the government in its wisdom had decided to grant relief in corporate taxation earlier, and now comes the version relating to individual taxation. Now, the tax rates, there are very few changes, very limited changes in the direct tax section of the budget speech. Perhaps this is mainly because whatever changes have to come, they have been reserved for the income tax bill, which has been promised to be introduced in a couple of weeks' time. Now, moving over to the next slide, we'll have a brief look at what other changes are there apart from the tax rate. As regards as individual and HUFs are concerned, there are a couple of changes. One, of course, is that in the current regime, exemption from income from house property was available for self-occupied properties up to 2, but there were a number of conditions attached to that exemption. That means exemption of occupied properties was available, but a number of conditions were there. So what is proposed is that they will do away with all those conditions, and anybody having up to two properties which are self-occupied will be exempt from income from house property. Then standard direction for salaried employees remains unchanged. A third change, which is important and which needs to be flagged, is that in the last budget, the updated tax return. The idea was that if a taxpayer has forgotten or any particular income in his tax return which he has filed, he can do so by filing an updated tax return up to a certain period of time and by paying a certain amount of additional tax on it. Now, this was a step in the last Finance Act, and the idea was to encourage voluntary compliance. And this is also digitization of financial data. Now, as we are aware, government is now collecting a lot of information on personal finances and financial transactions, and it is able to correlate all that data with the PAN of the taxpayer and the tax returns which are filed. So therefore, government has information as to what transactions has been taken and what transactions have been disclosed in the tax return. In order to flag to the taxpayer himself that there is a difference between what you have disposed tax return and what is appearing in the data available with the department. This step was taken that to encourage the taxpayers themselves to accept this change and make a updated return. Now that provision has been extended to 4 years now. That means that a taxpayer can update his return up to past 4 years where some transaction or some income has been omitted from being disclosed. And the third major change that is there in this budget relates to changes in TDS thresholds. Tax deduction at source has become a major compliance issue. There are something like 40 different provisions under which TDS is required to be deducted, and this adds to compliance burden both the deductors and deductees. So to sort this out in some form, what is being proposed is that threshold for deduction of tax at source is being increased in different for different categories of payments, so that compliance burden for those will become less. We can have a quick look at what are the changes being made in the next slide, please. Now, for example, TDS on bank interest was up to a certain limit, 50,000 for senior citizens, 40,000 for others. It has been increased to 1,50,000. Tax reduction on dividends was 5,000. Now the threshold is being raised to 10,000. Mutual funds, similarly, 5,000 to 10,000. Then rent was 2,40,000, being increased to 50,000 per month. So that means this reduces the burden payer as well as the payee, and it will also cut down a lot of processing. Fees for professional services and technical services increased from 30,000 to 50,000. So there is an attempt to rationalize and cut down TDS. Next slide, please. Slide. We move into international taxation. Again, very few changes have been made, but the changes that have been made are significant. First of all, if you see the general budget speech, there was a proposal to encourage manufacturing in electronic sector within the country. Support that, a presumptive tax regime is being provided for non-residents who provide services to resident companies who are engaged in establishing or operating electronic manufacturing. It means that a flat percentage of your receipts will be you can pay tax on that and get done with it. So presumptive taxation regime is being introduced for the first time for non-residents. Similarly, safe harbor rules for arm length pricing is being introduced for the same sector. And one important change which is being made in transfer pricing is that it is proposed that uh, the arm length price determined for an international transaction for one particular year will remain valid of 3 years. Now, this again will cut down a lot of compliance work, a lot of paperwork, will be welcomed by international, by non-resident taxpayers as well as the departmental authorities. Similarly, scope for existing, I mean, there is already safe harbor rules are there for arm length pricing. This the scope for these is now being expanded to further. Exact details will be known only when the rules are notified in this regard. Uh, right. Uh, there are certain benefits which are being allowed for International Financial Services Center and for sovereign wealth funds and sovereign pension funds, mainly to promote investment in specified infrastructure sectors. Next slide, please. These are benefits which are already there. They are now being expanded or extended to certain other categories or for a certain additional period. So the sovereign wealth funds and pension funds which invest in infrastructure sectors will be eligible for a total exemption from income if they invest these amounts till March 2030. Moving over to the last slide on the direct tax side, the government has announced certain changes in respect of startups. I mean, as per current provision, startups incorporated up to 31st March 2025 are eligible for various tax reliefs. This facility is being extended for up to 31st March 2030. Similarly, there are certain changes in charitable trusts in relation to charitable trusts, and there's one more important changes. I mean, which will have a consequence is that prosecution provisions relating to non-deduction of tax collection at source is being dropped. So, I mean, the effort is that to cut out uh, uh, criminal provisions in respect of activity, in respect of defaults, which already suffer civil penalties. So, in that context, TCS prosecution is also being the overall uh, position regarding direct tax proposals in the current budget. I'll hand it over back to you, Raj.
Thank you, Mr. Khan. We now move to the indirect tax proposals, and I'll invite Reena to make her presentation, please.
Thank you, Raj. Um, there are many changes in the Customs Act specifically which have been made. I think the idea first is, of course, we have seen over the years many a times goods are imported and the proper officer of customs is not sure about the assessment for the reason that some document is required or some testing has to be done in lab. And there are various reasons why at the time of import assessments are not done. So we are having historically a huge amount of provisional assessments which are done. Usually they are pending some test reports, some pending some further document. Sometimes they're also pending some judgments. So now I think because we have seen instances. I mean, I remember in Surat there used to be cases of 15-year-old provisional assessments which were still pending finalization, and probably bringing such cases to an end. In this budget, it's proposed that all provisional assessments should be finalized within 2 years, and that is extendable by 1 year in exceptional cases. Hopefully, this will close a lot of pending bills of entry, which are there at multiple ports. They have still, unfortunately, kept a little bit of an exception that wherever these circumstances exist, the 2 years will be counted from this date. So, if, for example, they are looking for some information from a foreign country and they are going through a legal process which is taking more than 2 years, or pendency of a similar matter before a tribunal, High Court, or Supreme Court. That's always a tricky one because there are always cases pending on similar issues. Interim stay by tribunal, High Court, or Supreme Court. This, of course, is in the very assessee's case if there is some interim order, or a specific direction issued by the board, or any settlement proceedings which are underway, where obviously the importer has gone to the settlement commission, admits a liability, and is seeking to close the matter. So I think the idea being simply that the dragging on of the assessments and the customs should come to an end. Abhilash, perhaps the next slide. Yes. I think similar to what Mr. Khan said, in customs also, there is an opportunity which is being given to importers that if you find that you made some error in the past because of which there was a short payment of duty, then you can voluntarily go to the customs department, amend your bill of entry, and pay the differential duty with interest. The idea being that, look, we are not going to, the customs is effectively saying to the importers and exporters, we will not penalize you, we will not take any action against you. You come voluntarily, correct. But all this has to be done before the short payment is detected by the department. And there is no time limit for this. You can go back as much as possible. So this is again sort of a scheme where honest taxpayers, if they find that there is something left out, they can go to the customs department. I think we have more in the next slide. Yes. So like I said, this facility is only available if it is prior to the detection of the short payment. That means before an audit, a search, seizure, or summons, or any other sort of formal communication to the importer-exporter. They have, of course, amended that now, even though you make a voluntary payment, and if the department is of the view that the voluntary payment is not adequate, then there is a provision for raising a demand. So, as an example, if you imported something in 2020 and in 2021 you realized you made an error and you went to pay for it now, the time limit for raising demands for short payment for the department would start from 25. So it's a double-edged sword because if you go voluntarily, you effectively waive the time limits and your rights in relation thereto. But it's also a safeguarding provision because now the customs authorities are putting very heavy penalties. Penalties tend to be equal to the duty amount, and many cases of prosecution are also being taken up. In the next slide is a system, another system which they have introduced here is that you can make a self-assessment, like I said, for a voluntary payment where there's a short payment. Even if you have made an excess payment, you can just make an application that please amend my bill of entry. And this is talking about amendment of bill of entries after clearance of the goods. So these are all past imports. You realize that I made a mistake, I've made an excess payment, you simply apply for amendment. Here, of course, they have put a time limit of 1 year because the amendment will be considered a refund claim if it's an excess payment. And that refund claim and your self-assessment consequent to the correction will be subject to scrutiny by the officer. And the officer can also reject your self-assessment and make some other assessment which may or may not entitle you to a refund. So when it comes to, again, a correction in a bill of entry, if it means more payment of duty to the government, then there is no scrutiny. Wonderful. It's all accepted. But if the correction results in a refund for you, then there is scrutiny, there is a verification based on a risk analysis, and also your claim can be rejected. So this is a little unbalanced. If we come to the next slide. Like I said, this amendment in the case of a refund is subject to verification, and proper officer may simply reassess the duty. And refund process the main advantage of this is now the refund process can start simply by an amendment application. Earlier, what used to happen is that if there was a bill of entry you filed on self-assessment and later on you detected there was an error, you had only 3 months to reopen it by filing an appeal. Now it's given a time of 1 year for the parties to take amendments. So it is actually a welcome move as compared to what was there earlier. If we come to the next slide, Settlement Commission tenure is now coming to an end. This has already happened in the direct tax side. Now, in the indirect tax side, also, Settlement Commission tenure will effectively be over by 1st April 2025. The Settlement Commission is going to be replaced by an interim board. And this interim board will only consider pending applications. No fresh applications will be accepted after April 1st, 2025. So this is again an alternate dispute resolution mechanism which is coming to an end. For some time, the Settlement Commission was extremely successful because many importers felt that one could go make voluntary disclosures and get the matters closed and also get an immunity from penalties and prosecutions. But I think the Settlement Commission has lived its purpose because now the section itself is providing various avenues for people to honestly go and make their deposits without any penalty. On hearing the budget today, there were a lot of changes which were announced in the rates. But when you look at it, it's a little bit of what I would call like a Trump budget, make in India, like it's make in America, it's make in India. It's all about make in India. And the focus on the tariff side has been typically what happens is it's a sectoral focus that, certain sectors are identified as focus areas and the rates are changed. But this budget has been sort of like a uniform increase in rates of final products and almost a uniform decline in the rates of raw materials and inputs. And focus certainly has been on sectors like telecommunication, electric vehicles, um, other technology areas also. So very thought out energy sector, alternate forms of energy. So very, very thought out, but it's really a make in India budget that somehow we have to promote manufacturing in India, and I think rightly so. Uh, I think another thing that the finance minister said is that we have to connect to global value chains. And perhaps what she means when she says connect to global value chains is that we have to support our exporters and domestic industry by making available cheap raw materials from other countries to them. Because if they do not get those, then obviously competitiveness is affected. One of the important changes, I think, which was mentioned in the speech also, there is an exemption on essential metals and minerals like cobalt powder, copper waste, lead waste, scrap, zinc, and all these things. There's also exemption granted for machines and capital goods for manufacturing lithium-ion batteries for mobile phones and electric vehicles. Similarly, tariff rates on solar modules, semiconductor devices have also been reduced. Seen holistically, obviously, we need many of these materials from China and some of the other sources. And for batteries, which are now critical, like I mentioned, for mobile phones and for electric vehicles, and batteries used for solar power also. So batteries has become a very critical component of the EV ecosystem, if we say. So I think by allowing free import, I think there is no duty at all now on these essential minerals. The attempt is that we do not want an import of value-added products, but to get the base raw materials and promote manufacturing in these areas. In the next slide. Yes. Next slide. I suspect that, we have been hearing a lot from President Trump that India is not allowing its motorcycles, US motorcycles and vehicles, and there are very high tariffs on those. And I think in a response to that, the tariff on high-end cars priced above $40,000 has now been reduced. Rate has been reduced from 125% to 70%. I think here really this is a sort of a concessional, move to the US government that, look, we are responding to your request. We want to allow foreign cars, especially US vehicles, a market in India. But really it's restricted to very high-end cars. So I don't know how much of an impact it will make, but certainly it's probably one of the very few reductions there are in this budget on a finished item. Premium motorcycles are also taxation has been reduced from 100 to 70. Cheaper motor vehicles rates have been reduced from 40 to 20, but there are some additional taxes which have been imposed, like an AIDC cess and others. So probably effective rate may not be so different than what it is now. There is an attempt to promote import of what we call semi-knockdown and completely knocked down vehicles. That's again an attempt to get the vehicles in parts so that manufacturing takes place in India instead of import of the complete car. So you'll see that for complete cars, tariff has been brought down to 70% or 40%, but semi-knockdown or completely knocked down are now at 20 and 10%. So certainly a lot of incentive for manufacturing in India. Tariff on used cars has also been increased. So that was another thing which was being happening, that importers had started importing luxury cars which were perhaps a year used or 2 years used at much lower values and trying to sell them in the Indian market. So I think they're trying to plug all the loopholes. Only the very high-end cars, there is a marginal reduction in the rates, but all other motor vehicles, which are not in the premium segment, the rates for the complete vehicles have been more or less maintained, and SKD, CKD parts are either exempt or at very low rates. Yeah. Coming to the next slide. I think I saw that some of the jewelry and gold stocks had gone up today in response to this. Rates of duty on jewelry items, gold alloys, all of those have come down from 25 to 20%. For gold and precious metal, because the value of the metal is so high that even a 5% reduction is huge for this industry. And gold, gem, and jewelry is a big export sector for India. And in India also, we have a very high consumption. Apart from that, shipbuilding, leather, footwear, all of these are again areas where raw materials and capital goods duties have been reduced, whereas duties on finished products have been maintained or increased. Coming to the next slide. Yes. There is also some procedural changes which have been which have been announced. Basically, it's about simplification of the regulations. Our regulations tend to be very complex, and a little bit of simplification certainly will make the lives of the importers, exporters easier. Some of the things is the filing of returns. Some are now made quarterly instead of monthly. Um, there are end use rules where if you import something for a particular purpose, you have to follow certain procedures. Those have been significantly relaxed. Time limits for meeting these obligations have been extended from 6 months to a year, in certain cases from 1 year to 3 years. So those sort of extensions and relaxations have been given. Coming to the next slide. Yes. There was a lot of emphasis on the fact that that exports is going to be a real growth sector. It's going to give impetus for the growth in the economy. And there was talk of giving export credits, cross-back border factoring support, and even support to MSMEs. to tackle non-tariff measures in overseas markets. Now, in other countries, there are a lot of technical barriers to trade which are being introduced, like, for example, a regulation or a certification and all those things. While the large Indian manufacturers are able to overcome those barriers and export to those countries, the MSMEs are certainly struggling, and it's really a very welcome move that the government intends to support them in meeting those regulatory requirements, because the MSMEs at many times are making fabulous products but are not able to export simply because of the technical barriers to trade. There's also going to be a digital public infrastructure, what's called a Bharat TradeNet. This is basically for uploading trade documentation, financing solutions. So again, a very good move. Cargo, which are again infrastructure and warehousing for air cargo, is also important because horticultural and agricultural products are actually not easily exported and imported into India because of a lack of warehousing facilities for such products. And of course, we are going to have a high level committee. I hope the committee, I mean, the objectives of the committee are very interesting. We just hope they give their report as soon as possible. I think that was what will make it meaningful. Coming to the next slide. Yeah, I think I will hand over to Raj back. Thank you.
Thanks, Reena. I think now we move on to the GST part of it, and I'll invite Shampa to give a presentation.
Good evening, my dear friends. Let me take you through the much awaited GST changes. But most of the GST changes are actually aligned with the 53rd GST Council meeting, which was held in the month of December last year. So let's look into as to what are the changes that have taken place. More of procedural changes that we look into. So the definition of input service distributor has been proposed to amend to include interstate transactions here, which should be liable to tax under reverse charge, which is more like an alignment with the reference to supplies subject to IGST Act of Section 5.3 and 5.4. Similar amendments are also recommended to be carried out under the other sections, which outlines the manner of distribution of credit by an ISD. These amendments are proposed to be made effective from 1st April 2025. So the change in transaction in ISD. Coming to the next that we see is there is a retrospective amendment which has been proposed under section 17.5D, which is basically about whether plant and machinery and the phrase plant or machinery has been replaced is similar or not. So this said amendment is proposed to ensure that the said phrase is interpreted as per the explanation now provided under section 17. So which basically talks about the restrictions of the input tax credit and the much hyped Supreme Court judgment in the case of safari retreats, wherein the Honourable Court had held that the restricted definition of plant and machinery, which excludes lands, building, or any other civil structure provided in the explanation, cannot be applied to the expression plant and machinery used in the section. So accordingly, the court, held that the word plant will have to be interpreted by taking recourse to the functionality test, and a mall, warehouse, or any building may also be treated as a plant, which is excluded from the purview of the exception carved out by section 17.5D. So it would be important to determine the validity of a retrospective amendment to section 17.5D, more particularly in light of this judgment. So I think it's a very welcome move that is, made things much more clearer and leaving the ambiguity back. We look at what is the proposal of the mandatory amendment of the pre-deposit. We go to the next slide. Pre-deposit for appeals before the appellate authority and appellate tribunal in cases where demand is only for penalty and not for taxes. So currently, if there's a case of tax, the pre-deposit continues. However, there was no pre-deposit for an exclusive case for penalty. But this change has been announced now that only exclusively if there is a penalty, the same shall be subject to a pre-deposit of 10%. However, if the matter is for tax and penalty both, then the pre-deposit is for tax amount only and not for penalty. Also, to be very clear, the appellate tribunal appeals will have an additional 10% pre-deposit in addition to what the deposit has to be done for the appellate authority. But this will be applicable only for the penalty portions. So this seems to be more of a welcome move as it reduces the hardships faced by many taxpayers in filing the appeals. Invoice management system. So it is proposed that GST credit notes pertaining to discounts, the set of GST is available only if the recipient has reversed the credit, especially in case of a discount cases. Now, this was particular to credit notes of discounts, but credit note issued under any other similar matter, specifically with Section 34, the condition of reversal of ITC by recipient was not prescribed. So the Section 34 amendment brought about and proposed this time will be aligned with the other credit note reversals which are there as per the discount cases. To specifically provide for requirement of reversal of input tax credit as is attributed to a credit note by the recipient to enable the reduction of output tax liability of the supplier. So the supplier will be allowed to only reduce his output tax liability provided the recipient has reversed his credit. So the government has introduced this enabling provision for invoice management, like we say, which is currently followed optionally, and it's not a mandatory requirement. Once finalized and legalized, and I would say the rules are much more in place, the taxpayers will have to mandatorily follow the IMS, which will make things more streamlined and uniform for all taxpayers. So we definitely look forward to provide a legal framework in respect of generation of Form GSTR 2B based on the actions taken by the taxpayers by following a mandatory IMS. The much awaited issues pertaining to taxability of vouchers. So the GST treatment of vouchers has been a contentious issue since the introduction of the tax. There has been an ambiguity regarding the classification of vouchers, whether as goods or services. It has been a pain point in the GST regime. Divergent views have been emerging on the issue concerning the specific time of supply provisions which are applicable under the Act. The Indian courts have conducted and concluded that vouchers to be mere payments, instruments, and not as an independent subject matter of levy. So it has been classified that transactions in vouchers will neither qualify as good or services, which has been cleared and proposed in this budget. However, taxability will arise when the sale transaction actually takes place. So when we say transaction will actually take place means whether there is any incidental expenses to it or there is an agent commission involved into it, which will determine whether there is a GST applicable or not. And this above amendment was in line with the premium sales promotion private limited case of the Karnataka High Court. We look into a more streamlining of the GST compliances, which talks about the track and the trace mechanism. So there's a new provision which has been introduced, which will empower the government to enforce a track and trace mechanism for specified commodities identified as evasion prone. The system will be based on a unique identification marking scheme, and the proposed scheme shall be based, which shall be affixed on the said goods on the package thereof. So it will basically provide a legal framework for developing such a system and help in implementation of mechanism for tracing specified commodities throughout the supply chain. So we should surely see an impact on the businesses who will have to, have operational adjustments in implementing and affixing and maintaining the unique identification methods. Our compliance burden would definitely increase. And of course, looking at the positive point, there'll be an improved credibility too, with an enhanced traceability, which may improve the supply chain transparency, building trust among stakeholders and the taxpayers. A very important change which has come up is the amendment to Schedule 3, which talks about that currently transactions involving a supply of goods warehoused in SEZ or a free trade warehouse zone are subject to different interpretations regarding their taxability. And why is that so? That's because it was unclear whether goods warehoused in SEZ or FTWZ are covered under entry 8A or 8B of the Schedule 3. While custom bonded warehouse goods have cleared exemptions for such transactions, SEZ or FTW transaction faced ambiguity leading to compliance challenges and disputes. So now the question was that whether SEZ, FTWZ, and DTA shall have the same meaning as provided in the SEZ Act of 2005. So such amendment is proposed to actually align the transaction relating to supply of goods warehoused with the existing provision in GST to a supply of warehouse goods to any person before clearance for home consumption. Consequent to such insertion of this amendment, a supply of good warehoused in SEZ or FTWZ to any person before clearance for export to a DTA will be treated as a supply of neither goods or services. So this recommendation is definitely on a rationale to align SEZ with provisions applicable to custom bonded warehouses. And we definitely see this as an amendment which is more than welcome by importers and exporters both, which will simplify the compliances for businesses operating in the SEZ or FEW and reduce the tax liability for the companies having their business startups or in any of these zones. So looking at the reduction in the prevailing litigation matters or interpretational issues concerning the taxability of supply of goods in SEZ or FTWZ to any person before clearance brings consistency in our policies too. So I think this is all that we have from our GST desk as of today from this budget. I'll hand over to Raj.
Thank you very much, Shampa. Um, so before we come to about the firm, etc., but I think it's time to invite our guests to pose their questions. Like I said, you can put your questions in the chat box and please mention to whom the question is directed to so that the concerned panelist can answer. So I invite and encourage all our participants to pose any question because you have with us three eminent experts on the panel. Well, I'm yet to see a question till now. Maybe I think we can start by asking our questions. So my first question is to you, Mr. Khan. What I would like to understand is that we have this old tax regime. So how is that impacted, or what are the implications for that old tax regime pursuant to today's budget? If you can kindly elaborate.
See, not affected at all. There is no change in that. See, old tax regime was that the taxpayers were eligible for various kinds of deductions relating to national pension scheme, deductions relating to risk policies, and so on. The effort of the government has tax regime into the new tax regime. So they have been gradually making it, more attractive for the new tax regime to operate. They have reduced the tax rate. They have reduced so that the net tax impact is lower in the new tax regime, and they have left the old tax regime untouched. So therefore, and that they have made the new tax regime as a default option. So unless you specifically ask for being taxed under the old tax regime, the new tax regime will apply to you. And within the new tax regime, there has been this tweaking of the slabs and tax rates, and the latest version is now before us.
Okay, noted, Mr. Khan. Before I come to, okay, I think we have a question from Srinivasan Vijay Kumar. Let me just try and read the question. Okay. Uh, mm, Srinivasan, you haven't directed the question to any one of the panelists in particular, but I'll put this across. So, Srinivasan's question is the overall budget going to improve manufacturing in India and lead to more exports? Second question or connected question, also, will it decrease the imports from China? And his question is open to all panelists, so feel free, anybody can take this up.
So shall I respond to this,
Please go ahead.
Raj? Yeah.
Please.
So I think the improvement in manufacturing has to come because whenever the tariffs are increased on the finished products, the local industry certainly gets a boost. So I do see certain sectors seeing advantage of this. And this is not something coming in this budget. This has been coming in the last couple of budgets, at least for the last 4 to 5 years. I'm seeing this. And gradually, the changes are becoming more focused, more targeted, and they are more thought out. So I'm quite hopeful that certainly manufacturing will improve in India. I can't really say that it will decrease the imports from China because reason is very simply that the imports from China are coming at prices which are so low that even with the tariffs, they are usually cheaper than what is available in other parts of the world, including India. So I think while this will make things better for Indian industry, I'm not that optimistic that it will result in a decline in imports from China. But the government is doing other things for reducing imports from China, and they are mainly by adding what we call certification requirements. Many imported products now need to be certified for under BIS and other regulations. And as a matter of practice, these certifications are being done for goods from all countries except China and some of the Southeast Asian country. This is another method by which the government is trying to restrict. And it's the same with steel. There is a registration requirement in India if you're importing, and you have to declare. So these little, hurdles which are being put in the way, I think have gradually affected imports from China for certain products. But of course, today imports from China are more than they ever were. So they're at a big high. So I can't say it's been that effective, but we are not the only country suffering from this. I don't think the US has been able to stop that, or Europe, or any other part of the world. They're simply making things which are at much lower costs.
Absolutely, Rina. I think import from China, in spite of, I'll say, all the intentions, it's been quite significant. And it's probably, in fact, it may go up because now that the government, at least at the political level, has taken steps to ease their relationship with the Chinese government. So probably it's not going to reduce. That's the point. I think Srinivas has a follow-up question. Of course, you can ask any number of questions, Srinivas. What will be the impact on Make in India on defense industry?
Well, Raj, I can attempt to answer this, but I'm not an expert on the defense industry. But certainly, what has happened is India has opened up the defense sector, and there are a lot of joint ventures which are coming in. And because India is actively going into manufacturing in these areas, I think the new policies will be helpful, but defense is something which needs a lot of steel and technology and all these things. So it's difficult to say how it will work out. But what is really helping, I think, the defense sector is that defense contracts have now local content requirements. And the local content requirements in the Make in India scheme are really what's making the difference, because Indian industry is now able to perhaps enter joint ventures, buy technologies, or have certain setup of programs which they help them make an entry into this area. Raj, I think you might know more than me on this.
See, the thing is, what I can sense about the defense sector, and this is some work that we have done. Uh, Obviously, it is having an impact, and this whole initiative of local content and necessity of therefore pumping in money in this sector is going to boost overall the defense industry. And as we know, there have been significant amount of exports from India as well in recent past or even in the present. So all in all, it looks like Make in India is having a positive impact on the defense industry. And to quantify it as a big growth, etc., I think it will still take some time for people to assess how it has really, really impacted. Thank you, Srinivasan. He says it was a great program. Thank you. Um, it, if there are any other questions, otherwise I can ask a question to our indirect tax specialists. Um, Reena and Shampa, you can choose whoever wants to take up this question. I thought one of the, again, aspirations from the practitioners and the industry was that the appellate tribunal will be made operational. So what's your take on that? I can see both ladies smile, so I think it's an interesting proposition. Both of you are on mute.
Shampa, you want to answer?
I'll let Reena answer. This has been a pain point discussion for us. I think every time we bump into each
Yeah.
other in the corridor.
So now I'm really extending it here, but I think I'm going out on a limb. I think 7 years is too long not to have a tribunal. And I've started now to suspect that the government wants taxpayers to just comply. And they want that if the taxpayers are not happy with something, they go to the government, make a representation, and get the changes made. They do not want the type of litigation which was there in customs and service tax and excise, and which is a huge amount of litigation still going on. So I feel it's like they're trying to delay it as much as possible. They've announced a delay of another 6 months. So earliest right now is 25 December. There was a president appointed of the GST tribunal, and he came and he gave us a speech to the indirect tax practitioners that we will have a tribunal in 2 months. And that has already been a year since that 2 months was said. So, and I mean, there are still a lot of issues. It's very disappointing for us because the big companies, they have the money to go to the high court and challenge these matters. They are able to hire senior advocates and they're able to take up their challenges. But it's the small MSME, mid-sized companies. They cannot afford to go to the High Court because of the legal costs, because of the interest costs, because the High Court does take 6 months, a year, 2 years to resolve issues. And in 2 years, 3 years, your taxes may be, interest itself is 50% of the tax amount, not to mention the recurring tax issues which happen if you dispute some aspect of taxability. So it's really effectively no remedy for the taxpayer, especially mid-size and small. But the only saving grace is that everybody is equally affected. So your competitors are also in the same boat as you. You have to accept whatever is being given. And to that extent, there is a uniformity in the injustice in the sense that everybody is doing what the department is asking you, and everybody is paying the higher tax. There's no, it's a level playing field. That is the only plus. But the minus is certainly, we have no recourse of raising certain legal issues. And to top it up, even if practitioners succeed on something in the Supreme Court, we have had three retrospective amendments in indirect tax this year, apart from the one Shampa mentioned, where the real estate industry was very benefited. They could take credits on construction costs. That, of course, has now been overturned with this proposal. Apart from that, even in customs, who is the proper officer to raise a show cause notice? That issue was agitated for the last 6 years. They've made already 2 retrospective amendments on that issue. They again lost in the Supreme Court, and now we have a third retrospective amendment. So basically, I mean, there is no winning. There is no winning.
But I like your concept of level playing field, at least some positive to take away from that. Is there any other question that any participant has? We have a couple of minutes before we close the session. Okay. Again, and Srinivas, thanks for asking all these eh, questions to the panelists. And he has another question open to anybody from the panel. And he says, it looks like the MSME is being really helped by this budget. What's the thought here for all of you?
Raj, I can only say is that the MSME really needs the help. That's the first thing, because, I remember there was a time when we used to say the small scale sector has to deal with 100 government departments. So, and they don't have the resources to do that. So, they're the ones who really need the support. Frankly, I think it's not enough. They need more. But of course, some of those changes, where those time limits for receiving payments, and I think in the direct tax provisions, I think those have been very, very positive development. I think Mr. Khan can
Right.
talk more
So,
on that.
yeah.
No, I agree with you. I agree with you, Reena.
And I think what will be interesting to look forward to, not just from MSME perspective, also from overall direct tax compliance regime and the whole mechanism, is the new tax bill, which is in the pipeline. I think that should be something one should look forward to. One last question that I had for Mr. Khan, because I read somewhere that while there have been certain tax exemptions that have been, and you also mentioned about it, that IFSC tax exemption, etc., has been widened. But is there an element where NRIs, and particularly the young professional students, they are going to face some tighter scrutiny going forward?
I mean, unless you're talking about liberalized remittance scheme under which education
Mm.
loans
Yeah.
were being remitted, and that has been
Mm.
taken out of the TDS provision.
Correct.
Yeah, so that change is there in the TDS provisions, but that's all.
That's all. Okay. I think this is probably now we are 3 minutes past 7. So I think we have reached the end of the presentation today. So thank you all participants for your time on a Saturday evening. Not an easy thing. So please accept our heartfelt thanks for attending the special session. And as we conclude very briefly about our firm. We are one of the leading and largest firms in India, and with a presence throughout the country, across other jurisdictions, and we represent many international corporations, PSUs, and large public companies. So, in case you have any question on whether direct tax or indirect tax, we have the necessary experts. You heard them today, or for that matter, any support that you or your company needs in India from an Indian law standpoint, feel free to reach out to any one of us, and the firm and the team would be very happy and pleased to assist you. With that, we close today's session. Thank you all and have a very good evening.
Thank you, Raj. Thank you very much.
Thank you. Thank you, Raj.
Thank you.
Thank you.